Save for posterity here. Okay, well, thank you everybody for joining us tonight. The reason I have is a background over here is a bridge with sunshine over it, a sunset over here is because what we're going to be learning today is about, some of the sunset provisions. And we're also going to be learning about a bridge from the past to the future, and now we're in the present. So we're going to be talking about the taxes of the past and what they've been. We're going to be talking about the taxes today and some of the changes that are made. We're also going to be talking about some of the implications of the taxes potentially in the future. So I can't help myself because there are like maybe 10 people who haven't heard my joke. I'm going to tell my one joke so people are going to groan and who've heard it before, but I will tell my joke anyway. The reason I tell my joke is because it's the only one that I know, and I think it makes sense for a segue into what we're going to be talking about. So the joke starts out with a guy walks into a bar, and he goes up to the bartender. He says, "I'll bet you $100 that I can bite my eye." The bartender looks at him. Seems like a pretty safe bet. The guy makes a bet with a bartender, and what does he do? Uh, the uh, the guy goes and he takes out his glass eye, and he bites his eye. So he bites it. So then the guy comes back to me and says, "I'll bet you double or nothing that I can bite my other eye." The bartender looks at him. Seems like this is not really a safe bet. It seems like a pretty safe bet. So what does the guy do? He takes out his uh, is it false teeth, and bites his other eye. I'm not helping you. So then he goes to the bartender again. He says, "I'm going to go to talk to the people in the corner over there. I'm going to got to talk to them." And he goes and talks to him, and he says, "I'm going to go back to you and say, I'll bet you double or nothing that I could put a shot glass all at the end of the bar, and I can pee in the shot glass, and I will not spill a drop in the bar." The bartender looks at it, seems like it's one of those really long 50-foot bars. And he says, "There's no way this guy can do it." So what does the guy? He makes the bet, double or nothing. $200 is on the table, and he goes and he ends up peeing all over the bar. Bartender is real excited. He's jumping up and down, and he goes to the person, and he goes to the person who made the bet. He said, "Why did you make that bet?" He said, "I bet those people over there $1,000 I can pee all over your bar, and you would be happy about it." So the reason I tell that joke, aside from on 4 hours of sleep, that's probably the worst I've ever told a joke. The reason I tell that joke is because it shows you that if you know the odds of something, you have a much better chance of success. And what we're going to be learning tonight is all the tax ramifications. We're going to be looking at taxes going forward in the future, in the past, and the present. I'm going to be looking and seeing what really makes sense over a longer period of time. So what we're going to be doing over here is going to be starting the presentation. I'm going to be looking at the one beautiful bill and what took place over there, and I'm going to be talking about the changes that were made there. And what's happened here is really we're going to be looking to try to minimize taxes going forward, and basically we're going to see that there's two systems of taxation in the country, one for the informed and one for the uninformed. And that's a famous quote from a judge, and that's what we'll be learning tonight about a lot of these changes that have been made in the system. So when we look at this, there's a number of changes that were made. And again, the thought is that these changes have been made permanent, but they're really not permanent because all these laws can be changed in the future with regards to a new Congress coming forward then. One of the main things we'll be talking about is the charitable giving provisions, which really have dramatic changes in the implications of that. And for those of you who live in a high taxation state like New York or California, I'm going to be talking about the state and local tax deductions. And then for those of you over age 65, there's a huge new opportunity with a senior deduction and the implications of that and how you qualify for that. We'll be talking about the Trump accounts, which I don't think is as big a deal as it's made out to, but if you have some children being born in the next few years, it could be an opportunity. I'm going to also be talking about the tax on tips and what happens there, and the tax on overtime, interest on auto loans, and some business opportunities, and also qualified opportunity zones. So with that as an introduction, Basically, we're going to talk about what's happening over here, and we're talking about what's still the same as the income tax brackets really haven't changed, which is really the main highlight is that they were supposed to sunset, and now they're not sunsetting. The standard deduction's been increased now to $31,500 for married filing jointly, and the IRA rules are also those are those really haven't changed. And the estate and tax gift exemptions, those also haven't sunsetted that. And right now, it's really for most people on this call, it's not really relevant. The estate and gift tax, you have to be like $15 million or $30 million. And it's something, but if you are in that level where it's something that does make some sense, there are some opportunities with regards to that. That's something to think about. Because I don't think the main point we're going to be hammering home tonight is that a lot of these things we're talking about tonight might not be around in 3 or 4 years. So you want to plan. This is like a sale at Walmart right now. You want to really look to maybe take advantage of some of these things. Now, the main highlight that we're going to be talking about tonight is with charitable giving. For those people giving money to charities now, if you use a standard deduction, you're able to, if you're 70 and a half or older, you can distribute funds from your IRA. That's a qualified charitable distribution. That's something that could make some sense today to do. But going forward, for people who don't itemize, they're going to still be able to get a deduction of $1,000 or $2,000. That's a new thing that they just added as a provision. But the main thing is that you really want to look, if you're somebody who has, if you give $5,000 to a charity every year and you have a $31,000, $500 standard deduction, and you never really get to that level, you never really get any benefit for giving that $5,000 to charity. What really makes sense is to lump those charitable contributions together. So instead of giving $5,000 a year to charity, what you do is you make one gift of $100,000 to charity. And in doing so, you're getting a tax deduction of $100,000. And then going forward, you can then take the $1,000 or $2,000 deduction for things you're doing going forward. But you have this $100,000 in a year when you're going to have the largest tax liability. Now, the reason why it makes sense to do it this year as opposed to next year is next year, when you give money to charity, you'd be subject to a 0.5% of your adjusted gross income limitation. So in other words, if you have $100,000 adjusted gross income, the first $500 you wouldn't get a tax deduction for. Also, if you're in a higher tax bracket, you're in a 37% tax bracket, with that, then you only get a 35% tax deduction. So now the main thing that really is cool about this, which I'm doing with a lot of my clients, is you're able to take your appreciated stock. Let's say you have NVIDIA stock that you paid $5,000 for, and it's now worth $100,000. You can give that $100,000 of NVIDIA stock to the charity, not have to pay tax, in my example, on the $95,000 of capital gains. And in doing so, you then get a $100,000 deduction. You avoid the capital gains tax on that. And in doing that, you then have this benefit and you have this money set aside. But again, this only makes sense if you're actually going to give, in my example, the $5,000 a year to charity going forward. If you're not charitably inclined, then what I'm talking about doesn't really make sense for that. So when we look at this, the other thing that could be important for some people who don't have high state and local taxes, it's not quite as important, but you have the state and local tax deduction. That's been increased to $40,000 effective 2025 to 2029. But it's interesting, there's a marriage penalty on it. Like you're able to get the income phase out between this is $500,000 to $600,000. It reverts back to the $10,000 cap, whether you're married or you're single here. So it's kind of interesting that you don't, being married is actually could hurt you if you have, two people making $500,000 each, they're out of luck. But if you have, so it's just something to keep in mind. And by having this provision here, it enables you to itemize more, and it gives you the opportunity to bunch charitable contributions and offset wealth conversions. Now, with all these things, it gives you the ability to really look at doing any deductions I'm going to be talking about today. Later on, I'm going to be talking about potentially the taxes going up in the future. Doing Roth conversions now could be really, really powerful, because when you'll see what the taxes of the future might be, you might want to do more Roth conversions. That's basically one of the big takeaways of tonight, is that anything you can do, such as using donor advised funds or your state and local tax deductions, it would make sense to maybe utilize those things now, and then you're able to get greater deductions going forward with that then. So now this is the senior deduction is actually something that is kind of an interesting thing. Um, you know, Trump campaigned on the fact saying that Social Security is not going to be taxable. Well, to dispel that myth, it's still taxable, but you have this interesting benefit where an extra $6,000 per person for people over age 65, you're going to be getting a tax deduction for that. So, and it's available regardless of whether you do a standard deduction or an itemized deduction. And the phase out begins on that at $75,000 and $150,000 married filing joint. So I've worked on this with a lot of different people, and really the main point that I wanted to emphasize with this is that the things that we're describing today are really complex, and everybody's situation is a little bit different. And it's kind of like playing three-dimensional chess over here. Like some people will see here, like there's ways to reduce your tax liability. And let's say you wanted to qualify for this, you want to make sure your income is below $150,000 here. So it would make sense to find ways to reduce your income below that. And I found some circumstances where just an extra couple $1,000s at taxation enabled people to lose this deduction. So it ended up costing them a lot more than you really think. So you really have to be careful about this senior deduction, because it's something that would be attractive to get this senior deduction if you could. But then again, we'll talk about taxes in the future and why it could make sense to just maybe in one year or so to be able to generate enough income where you don't worry about this then, and then you can get this deduction going forward. Now, this is something basically just to get an idea of the power of this for those 65. And I guess now that I've joined the club as 65-year-olds, this is actually exciting. You get a $31,500 standard deduction, an extra deduction for being 65. That's $1,600 for two people there. Then you get this $6,000 for the two people as well. That's $46,700 of deductions for people over age 65. So that's a big deal for people over age for 65 and older. Now, the Trump accounts, I don't think is that big a deal. It's basically you get a $5,000 contribution, and it's not that great a tax advantage. It's getting after-tax contributions. You don't get a tax deduction on it, and when you take the money out, it's ordinary income tax on it as well. So it's not that exciting. But what's interesting is that they're going to give you from 2025 to 2028 $1,000 for newborn babies. So not to say that you're going to have babies just to get $1,000 deduction, but if you're having babies at some point in the next few years, you'll get $1,000. So it definitely makes sense, I think, just to set up this Trump account just simply to get that $1,000 that the government's going to give you for it. So now the deduction for tips, I don't think this applies to many people on here, so I'll go through this kind of quickly. But basically, you get a maximum of $25,000 on tips. They deduct from 2025 to 2028. And it's available for standard deduction or itemizers. But again, it phases out for people making $300,000. It phases out, but probably most people making tips, it's not a real concern. Now, the deduction for overtime pay, that is also something that's interesting. You get maximum of $12,500 single or $25,000 joint, but the phase out again here, that also is from $150,000 single to married filing jointly for $300,000, and that's available for standard deduction itemizers. But the interesting thing I found out about this is only for the overtime can be deducted, which means if you're getting time and a half, it's only the half that can be deducted. So that's something that I thought was interesting in the provision there then. Now, for those of you who are buying cars, this is a deduction for auto loan interest. The maximum of $10,000 can be deducted for qualified loan interest. And the provisions there are kind of interesting. But the main point that they talk about is final assembly had to have occurred in the United States. And there are some cars out there that, maybe a Honda or a Toyota, they have factories here in the United States, they could qualify for this. So you just have to research this and see if it's something that you qualify for. And the phase out on this is $100,000 single or married filing jointly $200,000. $200,000. So going to go through this kind of quickly because this is a provision that's already in there. There's qualified opportunity zones currently in law that was created in 2017 and encourages economic growth in certain low-income areas. And it was supposed to be in these economically blighted areas, but it really wasn't in that period of time. It allowed investors to put their unrealized capital gains to work, and you're basically able to include have capital gains deferral, partial reduction, and eventual tax-free treatment on the new gains. These original 2017 opportunity zones lasted for 10 years and will end in 2026. But there's a new round starting in 2027. If you do that, unrealized gains invested can be deferred for up to 5 years. And if the full 5-year period is met, you get a 10% basis increase, which means you're not going to pay tax on that. There's an interesting provision there. The people in the farms, they were upset about the fact that everybody in these opportunity zones was in the cities. So the rural people got a 30% basis increase. So it remains to be seen. I just came back from a seminar yesterday where they were talking about qualified opportunity zones. And it remains to be seen what the investments will look like, because of course, as far as opportunity zones go, you want to make sure it's a good investment, because if you're in a qualified opportunity zone, if you put $100,000 in there and in 10 years it grows to $250,000, that $150,000 of gains would all be income tax free. So it's basically something to look at that. Like now, it wouldn't make sense to do a qualified opportunity zone because you're basically going to be paying tax on it next year. So it's really not a great opportunity, and it could be a great opportunity in 2027 as long as the investments which you're investing in are something that makes sense. So when we look at this, we also have business opportunities for business owners. There's a qualified business property, you get 100% deduction in the current year. Prior law was only a 40% deduction in the first year. So that's huge for people buying cars and also buying buying equipment and things like that. That's a big thing. And this is a provision which is a huge benefit for certain qualified small business stock. If you set up and you're doing like a startup and you set up this qualified small business stock, you're able to exclude capital gains. This is now, the benefit of this has increased from 10 million to 15 million, which is huge for most people. Or if you have some basis in there, you put $1 million in, $5 million in there, you'd get 10 times your basis, so you get a $50 million increase for that. And basically you have to hold it for over 5 years and you get this huge benefit. So it's interesting. I went to a presentation where they were talking about this provision, and they were saying that this could impact planned giving, because a lot of these people who used to give money to charity in order to get deductions are now going to not be paying tax on this anyway. So it's kind of an interesting provision out there. So that was just a quick overview of some of the provisions out there. There's somebody who's going to be listening to us later. There's also a change going on with regard to gambling losses, which is kind of an interesting provision they threw in there, because in the past, if you had gambling income of $100,000 and you had gambling losses of $100,000, you're able to deduct $100,000. Not now. Now, going forward in 2026, you're going to have only a $90,000 tax deduction for that. So they really, I guess the gamblers didn't work out too well in this current provision, the big beautiful bill there. But what's interesting about this is that they've done all these things where we're going to see that right now taxes are really low historically, and what we're going to be seeing here is that in the future they might be going up, and it's something that we want to maybe take advantage of these things while we have these what's going on over here now. My son Daniel, since we're talking about the bridge to the future over here, my son Daniel is going to be now talking about what's going on with taxes in the future. So Daniel, here you go.
All right. Okay. So, good evening, everyone. Hope everyone's doing well. And yeah, I'm going to talk about some stuff that's going on, ways to think about Washington, and how they sort of think about taxes. And I want you guys to work with me here to not think about taxes on any given year. I want you to try and zoom out and think of the game of life kind of like Monopoly. which is really long game. But with an added dimension there, the rules change all the time, in small ways, in big ways. And sometimes the people in Washington don't want you to know that they're giving you a higher tax bill. So it's often in sneaky ways. And then we're also, as my dad said, in a very low tax environment. And so let's take a look at that. So this is the highest income tax rate, um, each year from 1913, which is when it started, to 2020. And there's a lot of interesting stuff on this chart. So the first thing I want you to look at is where we are now. For the last 30 years or so, we've been pretty consistent. Um, and that's sort of what a lot of us, have experienced, and that's what we're familiar with. But I want you to look at how consistent it really has been, and it's always the highest tax rate's been under 40%. Um, and I want you to then look at this period, which is from 1934 all the way to 1983. That's a 50-year period where the highest income tax rate was never below 70%. And so the point there is, you know, things do change. Even if it feels like it's been the same forever, which, from 1990 to 2025 feels like a long time, but when things change, they can change dramatically. And so we'll keep that in mind. Okay. And so I said that there's some sneaky ways that the government can raise revenue. The first thing I want to look at is the traditional IRA. And this actually happened a while ago, back in 2019. So for the longest time since IRAs started out, they were a great way to defer taxes, where you don't have to pay any taxes on your money at all, until you take the money out, and you don't have to take all the money out at once. You could take distributions. You're required to take distributions when you hit a certain age, but even then, they're small distributions, and then so can your heirs, right? So they can take it out over their lifetime, small distributions each year, and it's not really going to hurt your tax bill that much. That all changed in 2019. That was called the stretch IRA, where if you inherited, you can take out over their lifetime. Now, the money has to be out within 10 years. And so, what that can mean is for some people, they have to take it out over a 10-year period. Um, and some people choose to take that all at once, depending if the distributions were turned on before. But that could be a huge tax bill. Let's say you have a $2 million IRA. That could be over 10 years, 200,000 a year of income on top of what you're already getting. A lot of people who are inherit IRAs are working, so that's just 200,000 of additional income they didn't really even need. So this is just a huge, uh, you know, planning issue for a lot of people. A lot of people love their IRA, and with that said, we were at this conference and we got this interesting little way to remember this. Your IRA is not your money, it's really a joint account with the IRS. So I want you to think of an IRA as an IOU to the IRS. Okay. And so this piece right here, the government budget, might actually give us a hint into where taxes are going. So let's take a look. So right now, we bring in $4.9 trillion of total revenue, which is a lot of money. But the mandatory spending is 4.1 trillion, and that includes Social Security and Medicare. And you add on top of that another trillion of interest on our debt. Plus, we haven't even gotten to the part where we have all this discretionary spending, which includes a lot of defense, but also a lot of the other things that you think of, like schools and parks and all that. That's only 2 trillion, but that adds up to almost $7 trillion of spending, which leaves us with a almost $2 trillion gap. And so as of today, we have a 38 we're $38 trillion in debt, and each day we go into debt by 6 billion more. So that's a lot of money. And something you'd think eventually would have to change with that. And just on this slide, just a small point, but we actually are now paying more in interest alone than our entire debt, and than our entire defense budget. So that just shows you how much interest we're paying.
And one thing to keep in mind is that Social Security and Medicare alone is $75 trillion of unfunded obligations. So what we were looking at in that past chart of the $38 trillion deficit now, you have these unfunded obligations of Social Security and Medicare, which is like a ticking time bomb, which they keep on kicking down the road. So that makes the thought of maybe taxes being going up in the future, I think, a greater likelihood.
Okay, and so this is sort of a confusing graph here, chart. But the key here is certain things, not everything's increasing equally. When our spending is increasing, it's not usually over the things that we would think about, like funding parks and schools and stuff like that. It's these big ones. It's healthcare, Medicare, Social Security, and the interest that we have to pay. So these things are not as easily maneuvered. They're sort of unavoidable unless something big changes. And so, really, what that's saying is this snowball's rolling down the hill, and it's not really easy to change that. And so, let's think about some ways that your taxes could change. There's two pretty intuitive ways they would change. You either change the brackets or the taxes change. And so with that, there's a new sort of tax that a lot of people don't know about or think much about. This is Irma. I know there was a Hurricane Irma at one point, but does anyone know what Irma is, or what does it stand for? So it's actually the income related monthly adjustment amount. And where this comes into play is Medicare. And so Medicare Part B and D, they're a great way to pay for healthcare, to fund healthcare, and get coverage. But not everyone pays the same amount for Medicare, and that's where Irma comes in. So, and this actually has generated a lot of revenue for the government over the last 5 years. They've actually increased this, we'll call it a tax, by 7% each year. And so that's actually how they've gotten a lot of revenue. And so here's basically just a walkthrough of what Irma is. So when you get your Medicare Part B, which is the main part of Medicare, and this also applies for the drug plans as well, you pay $185, assuming you're under this threshold. But that's a big difference from those who are making 750K or more. They would be paying $630 for the same coverage. So 185 to 630, and the only point here is that it has a 2-year look back, so it's based off your income 2 years earlier. Okay, and so there's 4 ways that you can get taxed in retirement. These are the main ones: income tax, Social Security, taxation. This can change. There's some maneuverability here. Right now, it's taxed up to 85%. That could go up. And then there's capital gains, and then what we just talked about, Irma. And so if you look at the middle quintile, which is basically your average American, they were taxed 30% higher than they were in 2000 and 2020. And it's down a little bit from there, but it's still, taxes are pretty low. They were higher in 2000. So we're going to sum it all up now with what to do about it. What we really want to look at is ways to, uh, you know, get your money out of a joint account with the IRS or out of reach of the government. Um, and so the way to do that is not think about your taxes in 1 year, but actually over a lifetime. And so what that really brings you to is, not falling in love with your IRAs, but instead looking to do Roth conversions and life insurance. These are ways that you can pay tax now on your money, and then it can grow income tax free, and that money is fully yours. Um, and so sometimes that hurts. You're paying more taxes now, but basically that's the game that makes sense to play right now with taxes at historical lows. And yeah, that's basically the gist of it. And we'll open it up
So,
now
so,
for
so basically, the whole gist of this seminar is just to show you, like, again, the taxes of the past, which have been historically, um, the taxes of the past were much higher. The taxes of today, which are actually historically very low, and the taxes of the future, where if you're doing just pure math and you see a $1.9 trillion deficit every year for the foreseeable future, and you have $75 trillion of unfunded obligations, if I was a betting man, I would think the taxes are going up in the future. So we have this software which we utilize, which we kind of look at people's marginal tax brackets, and you can kind of see all the interactions that are going on with this. It's kind of like you're playing three-dimensional chess. You're trying to uh, minimize taxation over today, but sometimes people will come in and they'll say, "Oh, look, I've paid nothing in taxes," and what I tell them is that you can't go back in time and end up paying more in taxes, and to try to use that. So you really want to, like, look to get up to a certain marginal tax bracket and pay a fair amount of taxes now if you can, because ultimately down the road, as Daniel was saying, you know, the IRS has an IOU on your IRA, and it's something that's really important to be thinking about. That you think you have $1 million in your IRA, you think it's yours, but Uncle Sam has the ability to tap into it and take whatever they feel like at that point in time, depending upon whatever the rules are at that particular point in time. So that's why I think when you take a short-term view, you can kind of miss the larger view of, like, taxes could be much higher in the future. And if you're looking to have lower taxation in the future or leave money to your heirs in a more efficient manner, it makes sense to look at the long game as well. So um, that's basically it. It's kind of a simple and complex at the same time. The big picture is you want to look at your tax situation now, take advantage of all the provisions out here that you can, but also think of the long game and try to minimize your taxes. So I know we threw a lot at you in a short period of time, but we have a lot of people on this call. But if anybody has any particular questions, please feel free to unmute yourself and ask.
Hey, Stephen, question, life insurance, how does that play into the long game?
Well, it does one of two things. One is you're able to, I call it like a Roth IRA for rich people, where you're basically putting money into this. Like, you don't qualify for a Roth, you could put money into a life insurance policy, and it grows, income tax free, asset protected, and it goes inside this vehicle where you can tap into really at any point in time. So to me, it's a really attractive vehicle to have this money in here, and historically, life insurance has not been taxed. And even when they did change the rules in 1982 with regards to life insurance, they grandfathered the policies that were already in effect. So that's one way it could be utilized, to like a Roth IRA for rich people, building up a bucket of money that could be tapped into when people retire, income tax free. Also, what I like about life insurance is it provides you the ability to, if the market goes down by 40%, life insurance would generally, if it's structured right, wouldn't go down at all. So it gives you protection against point in time risk. So it's an important vehicle to have set up over there. I think that's one way of utilizing it. The other way of utilizing it is if you're planning on leaving money to your kids, if you leave it to your kids in a, in an IRA, they're going to have to be, as Daniel was mentioning, they're going to have to pay tax on that and order income taxes later on down the road. So rather than doing that, you can take the money out of the IRA and you can put it into a second to die policy. And in doing so, you would be having the kids pay tax, not have to pay tax on it all. And if you're subject to a estate tax, you wouldn't have to pay estate tax on it all. So life insurance is a tool that can be used to minimize estate taxes, can be utilized as a vehicle to leave money to your kids in the future. And it also could be utilized for people, younger people putting money aside to have that money grow income tax free. And it gives them the ability to tap into earlier, like with an IRA, for example, you can't take the money out before you're 59 and a half, but life insurance, you can tap into do numerous things. Like I bought my office in a short sale when everything else was difficult to tap into. So, so that's really why life insurance is something that could make some sense. I know you're always good for a question, Curtis. So that's good.
I'm going to ask about the Roth conversion as well. So what's the, how much can you do with Roth conversion in 1 year?
What I tell people is there's absolutely no limitation. Like Bill Gates, like people think, oh, I'm not eligible for a Roth. Well, you are. I mean, you can basically have, $100,000, $1 million, $5 million in an IRA, and you can say, I'll pay tax on the $1 million today. You pay, you add $1 million to your taxable income, and you then, voila, you have $1 million in a Roth, which isn't going to be subject to this, the IRS saying, okay, you think you have $1 million, but you really don't. You owe me money. So we actually have this other software which I can show you in another presentation, which we were looking at, like which I can share with anybody on this call. It actually shows you like the lifetime taxes that you're going to have in your IRA, and it kind of like goes through and breaks down the taxation you're going to have on the distributions, and then if you took that money out, the taxation on that, and then what will happen to the heirs when they get it. And it was really astounding to see how much more that was going to be than if you just like paid the tax now. But to me, I get a little geeky about all this stuff. Like I wouldn't want to convert a lot of the, to a Roth IRA right away. But the key thing, and this is where it gets kind of complicated, is you want to like look at your marginal tax brackets, and if you can be like up to the 22% bracket, you might want to do some conversions or look and see what could happen going forward by doing other conversions as well. You want to kind of take advantage of these things, because the point is that I think it makes more sense to not get excited about paying low taxes now, because that's not really that hard. The taxes are low, and because I think that ultimately later on down the road, 10, 15, 20 years from now, tax rates could be 40, 50, 60%. And you would be really happy that you'd had a little bit of your money in something that was income tax free. And really, when people talk about diversification, people talk about diversification of their assets. I think people should be talking about tax diversification. I think everybody should have some money in a tax-free vehicle, whether it's in Roths or life insurance. They should have some money in tax deferred, but not as much as people would think. And then also have taxable accounts which they can tap into.
Hey, Steve, probably
Yes.
a stupid question. I'm sure everybody else knows the answer to this, but is the only difference between a basic IRA and a Roth IRA is that you're paying the taxes on a Roth now and you pay the taxes on a regular IRA when you take out the money?
Yeah, basically, if you take money out of, you could pay, if you cash out and you do a Roth conversion now, you would pay tax on it now. So if you had $1 million or $100,000 in an IRA, you converted it over to a Roth, you would pay tax on $100,000 now, and then all that income coming out would be income tax free.
But if it's a traditional IRA, you get the tax break up front.
Well, that's the thing is you got an advantage of doing a tax. If you put in an IRA, you get a tax deduction today. So the way I sometimes give the analogy, would you rather pay tax on the seed or on the corn? So, you get a deduction on the seed for the IRA, but on the corn, the crop that you have later on down the road, you're paying tax at a higher level. And that's why all these things that people are like excited about, like, oh, I used to have my RMDs at 70.5, and now they can be 73. And then over time, they'll be extended to like 75. You think it's really a good thing, but like Uncle Sam is waiting there and saying, oh, I really hope your IRA gets nice and juicy and it gets to be really big because I get a share of that, you know? What's interesting also is that the government in their infinite wisdom has made it like for high net worth people in their plans are now forced to do their catch up contributions and things and to put it into Roths, which is actually in their best interests. And this is where for those younger people on the calls, if your income is not really that high, I think it makes more sense now to put money into a Roth 401k rather than in a deductible 401k, because I'm a big believer that taxes will be higher in the future. And I think it makes sense to at least think about that. And maybe you don't have to put it all in the Roth because you might want to get some tax deduction and you can kind of play with that. But maybe just being aware of that as being an option, because a lot of people, kids making, whatever, $100,000, $120,000 a year, it probably makes more sense at that tax bracket to put money into a Roth 401k.
Is that something that most companies will offer, the option to do either or?
Yes, most companies have that option.
Hmm.
And that's something we should look at for your kids as well.
Yeah.
But the maximum stays the maximum, right? You can split it, but
Yeah, the maximum is still
23,000
going
or
to be
something like
it's going to be 23,000. So
Yeah.
you could either put 23,000 in the Roth or 23,000 in the deductible 401k, or you can split it up any way you want with that then too. But there's other provisions there that, and that's why this actually gets really complex. But I like it. It's like it's a three-dimensional puzzle. Like you want to find ways to reduce your tax liability now, but also I think it's important to have an eye to the future and kind of see what these taxes might be in the future. And what somebody once said at a seminar, which I thought was interesting, is that you can't go amend your tax return to say, you know what, I should have paid more in taxes that year. I should have done a Roth conversion for the last 5 years. I'm going to meet with somebody on Monday. They're like 80 years old and they have $4 million in an IRA, and they were complaining about the fact they have really large tax liability. Well, it's like, I really should have met them 20 years earlier. There's not a whole lot I can do about it at this particular point in time. Like they have $4 million in an IRA and they're going to pay a lot in taxes. Now, for somebody like that, it might make more sense for them just to bite the bullet. And, if they don't need the money, maybe to put it into a second to die life insurance policy, and then they wouldn't have to worry about that taxation going forward. And also wouldn't affect their IRMA surcharges going forward as well. Because that's the thing, is that what Daniel was showing over there is that it's like a ticking time bomb. Like, it's like a balancing act between whether you should generate a huge tax liability in 1 year in order to pay less in taxes on all these little nickel and dime charges they're having, like the IRMA surcharges and things like that. Because the government is sitting back there and saying, well, we have a vehicle where we can make you pay as much for Medicare as we want. And they're doing that. And we have other vehicles out there where we can make you pay as much for your IRA. And they're going to be doing that ultimately down the road too. And right now you might think your taxes are low, but they're permanent. But all it takes is another election and a change in things. And it's just, to me, I think the math is pretty compelling when you see a $1.9 trillion deficit every year and you see $75 trillion of unfunded obligations to Social Security and Medicare. If I was a betting man, I would say taxes are going up. And, math ultimately wins. And, what the problem with this is when you go back and you look at all these things going forward, you can see, what is a budget deficit? Like this, the key thing here is this net interest. Right now interest rates are higher, and that's what's hurting the government. Like this number is going to get bigger and bigger. And ultimately it's going to crowd out more of the so-called discretionary things that are in here. And the discretionary is really not very discretionary. Like 50% of the discretionary is in like the military. You're not cutting back in the military. I don't think that's going to go over very well. So, this, and you could talk about all the government waste and what's going on with it. It's just like, there's not a whole lot you can cut. Like when this mandatory spending is Social Security and Medicare and interest and things like that, it's not going to be cut. So it's just something to keep in mind that it's a really I don't think it's a difficult puzzle to solve. I think the puzzle will be ultimately you and I are going to pay more in taxes in 10 years. And that's why I think it's important to have an eye towards the future, and that's why I guess it was the holiday theme I was talking about, the ghost of the past and the current and the future. So, which is, an analogy from a Jewish guy is kind of complicated, but anyway, that's me. So,
Steve, just one quick question. How realistically, how quickly can the tax rate go up? Like, can the Fed just say, hey, we're in such high deficit, we have to raise taxes today,
well,
tomorrow,
yeah, it's
here,
like,
whatever it is? How much can they
Look at World War
realistically
II
increase it?
or the Great Depression. I mean,
well, it's just like if the government needs money, they can go back in time and they can say, look,
1934.
they can say, hey, we have a great Great Depression. We'll make our taxes 90%. Now, this is not quite accurate because I started working in 1986 over here, and yes, taxes were lower, but there were a lot of tax shelters and things like this that people can do. So they kind of like took away some of the shelters and had the taxes over here too. But in general, the government has the ability, in World War II or all it takes is for Congress to say your taxes are now 50%. And you know what your taxes are? 50%. They could just write it tomorrow. Just like the government came out and said your taxes are now staying the same, or they're going to have this, the things you're talking about tonight, like no tax on tips or whatever they come up with, it all just has to be written down on a piece of paper and then it's the law. And that's all it takes is for them just to say your tax rates in the tax table are now up, 10% more. And then next year they'll be up 10% more. It's as simple as that. So they're permanent until they're not. I would say all the tax laws are written in pencil, which to me makes it fun because it makes my job fun because I get to work on all these complicated things and get to explain it to people and they get to say, wow, I don't understand that. But it's like, and the interactions of it really get to be complicated because again, you wanted to try to look at and I've met with just in the last couple of weeks, I have this software which I use with people and we kind of look at, people's taxes and we're able to see like, well, what if we did this? And you try to see some ways if you increase their tax liability, they're up to like the 22% bracket that's not costing them that much money. But if you like did an extra $5,000, they start to lose that senior deduction of $6,000. Or what if you had a really big year and you're getting a big bonus or something like that? You can do this donor advised fund thing and you can reduce your tax liability. So there's all these mechanisms out there where you can either, or you can do other things like you're selling your building, but you can move it into a like kind exchange, and there's all kinds of ways to reduce your tax liability, or there's ways to do the Roth conversions and do things like that. Which yes, you'll pay more taxes now, but ultimately in the future, I think you'll be paying less in taxes.
Hey, Steve.
Yes.
Steve, relative to the question that was just asked, and I think you said it very clearly, but just to summarize, what you're saying is the Fed or the Treasury Department or any of those agencies, they cannot change tax rates.
No.
A change in tax rates requires congressional action. However, Congress can act any way they want anytime.
Correct. And that's the thing is the Fed has nothing to do with raising taxes. They control monetary policy, but all Congress has to do is, they just go out there and they say your taxes are this rate, and that's what it is. It's written in law, and that's the way it is. And that's basically what happened when Reagan got in office. He just basically passed these lower tax rates, and they were lower. you know, and you had the Kennedy era, you had higher taxes and then little tax cuts here. But in general, these taxes were really high for a long period of time, you know, so, you know, it's just Congress can do anything they want. It's written in pencil, whatever they do. And that's really the main thing is all you have to do is have control of the government and they can write rules and those are the rules you're subject to. And I just think regardless of politics here, you just have to think about math. I mean, I just look at $1.9 trillion a year of deficit and $75 trillion of unfunded obligations. I don't know. And I'm part of that unfunded obligation because a lot that's Medicare and that's Social Security. And you know, I think the one sure way to not get elected or reelected is to go back and because people ask me, what about my Social Security? Is it safe? I'm going to get like in 2035, like, you know, 75% of the benefit. I don't think any politician would get elected if they went and said they're going to cut back on Social Security. But what I think they are going to do is they could do certain things around the fringes with like, you know, having people work longer to get their Social Security. They can play with the inflation adjustments. They can do a number of different things to impact that. And I think, you know, increase the payroll taxes. There's lots of things they can do. And that's what they will do because there the math is getting closer. Like I used to think that 2034 was really far away. It's not. I was looking at this stuff 10 years ago, and now, you know, nobody wants to be the one to raise taxes on people, but ultimately there is going to have to be some kind of grand compromise because old people vote. They'll be out there saying you can't increase my Social Security. You can't take that away because for some people Social Security is a big deal. It's like 80% of what they bring home. So for some people it's a really big deal. So I don't think they're going to be doing anything with that. But ultimately, that's part of the $75 trillion of unfunded obligations. And that's the other part of the math that's kind of like behind the scenes. And you think that your Social Security is actually there for you in a box that your name on it. It's not. It's basically the government is going to pay you what they think they're going to pay you. So that's another important point. Any other questions?
That 1.4 trillion deficit in Social Security, that's on top of even the revenue that's coming in, the Social Security revenue that's coming in.
Yeah, so there's a $1.9 trillion current deficit, right? And then
Yeah.
it shows you over here that
Yeah, the breakdown.
the breakdown of where was that? Back. It was showing you the point that's not in here, which I didn't get a chance to add to the slide, is it's showing the $75 trillion.
No, it's right before go forward. Slope. Yeah. Next slide. There it is.
Yeah, this is just showing you all the different government budget. And this is showing what the budget's like. And things like Social Security, they're not touching that. And that's part of the you know, the stuff that can't be you know, not going to be touched. And you have Medicare as well. It's not going to be touched. This is part of this amount, which is not going to be touched.
But how much Social Security revenue is coming in? Right? Because
Well,
I'm paying Social Security tax now.
You are. And the point is you're paying for they're saying right now you're funding like ultimately in 2034, you're only going to be funding 75% because right now there's enough people to pay that. But ultimately when there's enough old people out there where they start getting older and they start taking more and more money, then you're going to be having all that unfunded obligation. So the only way they can do it then is to decrease the Social Security that's going out to 75%. But they're not going to do that because old people vote, and that wouldn't be a great way to get reelected to say, you know, grandma's not getting her Social Security. So so they're going to have to either increase taxes or change the rules on how you get it, or have for me, I would think the one thing that they would look to is have younger people pay it and they'll make it going for. That's the one that I'm for, but my kids don't really like that solution too much. Nope. So anybody else? We have a few more people left over here. Okay. So okay, so I'm gonna if nobody has anything else, we could oh, we do have a lot of people on here. So that's it. Nobody else has any questions. just if anybody has any questions offline, the main part about this, which is you have to have the tools. I think it's really hard to look at this in a vacuum and kind of see what to do here. You really need to have the software to kind of figure out what your situation's like and to kind of analyze it and to see what it makes sense for, in your particular circumstances. So thank you, everybody, for joining us. And it's a wonderful Thursday evening.
Thank you.
Hey, thank you, Stephen. This was great.
Okay.
Thank you, guys.
Okay. Bye.
Thank you again.
Thank you.
Okay.
Thank you, Steve.
Thanks. Okay. Bye.
Thanks, Steve.
Thank you.
Thank you. Thank you, Daniel.
Thank you.
Okay. I'll visit with people now if anybody wants to show their face. But other than that, it's like playing Hollywood squares with blank squares out here.
Steve, are you going to share the recording? Because I'm sure Sandy would love to hear.
Yeah, the recording will be available because I had a lot of people who couldn't make it. So the recording should be available in about a week or so. If anybody, there's a place on our website where they'll have this recording, they'll have the market update seminars and what to do in retirement. Those will all be on the website. And I'll show you where that is, Lisa, at some point.
Great.
And
All
then
right.
we'll just send you a link for it as well. But thank you all, everybody, for
Okay.
joining us, and
Thank you.
we'll talk to you soon. Okay, bye.